All right, hi everybody. Again, welcome to today's webinar, Energy Storage Project Development, an overview of key policy, finance, and development issues. Thank you to everyone who's on with us today. We do appreciate you taking time out of your day to be on with us, and we're pretty excited to get started. This webinar is being co-hosted, as a lot of you know, by international law firm K&L Gates, who just recently published the fourth version of their Energy Storage Handbook, which we're going to be talking about a little later. We're really excited to have them on this webinar with us and to dive into everything that they have uncovered. A couple of things to mention before we get started. We always do Q&A at the end of the webinar. So if you have a question throughout, just chat it into the chat box and we'll get to as many as we can at the very end. And of course, you'll be getting a recording and the slide deck of this webinar in your inbox shortly after we finish. You can pass that along to anyone who couldn't make it on today. So again, we are really excited about the group of panelists we have on with us from K&L Gates, who all played instrumental parts in researching, writing, and publishing the Energy Storage Handbook. Elizabeth Krause, a partner at K&L Gates who specializes in tax, will be talking a little bit about federal and state storage incentives. Buck Endeman, who is the editor of the handbook and partner at K&L Gates, he will be touching on regulatory and developmental hurdles with storage. And Jim Rathall at K&L Gates, he specializes in project finance, EPC, and development. He will touch on some project finance issues. And of course, we do have Adam Gurza from Energy Toolbase, who's going to be talking about SGIP and the SMART programs and where those are today, and various incentives and finance configurations within Energy Toolbase. So as I did mention before, I do want to plug it in here again, but K&L Gates just recently published their fourth version of their Energy Storage Handbook, which I'm sure some of you have already seen. It's a great resource, completely free for you to take a look at. And this handbook really talks in depth about these laws and regulations that are currently shaping the development of energy storage, and also dives deep into the issues that the market is facing moving forward. So for everybody that's on today, we will be sending this link to the handbook out after the webinar, so we really encourage you to take a look at it if you haven't already. And before I pass it on to all of them, I do want to take a quick look with you at the energy storage market and where it kind of stands today, as this is going to set the stage for what we're going to be talking about. The Q2 energy storage report was just published last week, so it's really recent, by Wood Mackenzie Power and Renewables. And this kind of just talks about the growth of storage and how it's continuing at a pretty fast pace. So we put some of the stats on the screen, but Q1's deployments were up 232% year over year, with behind the meter deployments making up about 60% of the total deployments for the entire quarter. And that's up nearly 40% from last quarter, and a big reason for that is the increase of incentive programs like SMART and SGIP, which Adam again will be talking about later. And I'm sure you kind of all know what happened with those. But another thing that added to the growth is the fact that there are so many new technologies and policies that are constantly being introduced. And not too surprising again, but California continues to be the top state for both residential and commercial. So as you can see, the deployment numbers are good, but there's still a lot of challenges that the market is facing, especially regarding behind the meter projects. So with that, I'm going to hand things over to Elizabeth from the K&L Gates team.
Thanks so much, Tracy, and welcome everyone. Thanks for joining us. I think, Tracy, if you want to go ahead to the next slide, please. So federal taxation is really one of the biggest questions here. I mean, state and local varies a lot. It's all over the map. There are some income tax incentives, but most of the ones that we see right now are property tax or some other kind of excise tax. And Adam's going to talk about those a little bit later on, so I don't want to steal too much of his thunder. I think the point is that anytime that you go to put in a storage facility, particularly outside of the state of California where the incentives are much clearer, you need to spend a little bit of time sort of researching those and seeing how you can make them work for your investors, and then also how you need to make, how do you need to qualify your project. So on the federal side, though, we've got a fairly discrete set of rules right now under the investment tax credit. There are two different kinds of credits in play. The commercial one, which is, of course, the investment tax credit. And then there's also a residential credit, which works a little bit differently. It's only available to individuals. It's only available in respect of property that they have on their residence. You can use both of these credits for hybrid systems. That's quite clear. So solar plus storage, wind plus storage, pretty much anything like that. If it's ITC qualified, then you can use the ITC for both the storage and the wind and the generation. Obviously, that's easy with solar plus. Wind is a lot harder because there's not really clear guidance for taking storage and installing it separately and qualifying it separately for the ITC. So what I mean by that is separate ownership, separate timing, anything along those lines where you don't have installation at the exact same time as the generation and at the exact same time as generation that also qualifies for the ITC. Any of those scenarios becomes much, much muddier. There are some arguments that we can make in certain cases. There are very good arguments for the residential credit. As many of you probably know, PLR 2018-09003 was released last year. That PLR rather importantly said that a homeowner who installed a battery a couple years after installing solar panels could qualify that battery, in principle anyway, could qualify that battery for the residential credit. It's an important win. And there are people out there, anecdotally anyway, who I understand do install storage at commercial facilities after installing generation and at least attempt to claim the ITC, but the principles and arguments are not exactly the same across the credits. So it can make it a little bit more difficult. Tracy, could you flip to the next slide, please? So one thing that you all have probably heard about, though, is that there is currently legislation, bills specifically, in both the House and the Senate to extend the investment tax credit to energy storage. These are interesting bills. They're virtually identical, and actually they are exactly identical at the moment. They would authorize the investment tax credit for storage under a timeline sort of similar to what we've got for solar right now, and specifically that it will wind down over the next few years. Now, a lot of folks have been very excited about this for a couple of months. I mean, they're great bills. They're exciting. We've tried something similar in the past in a much more broad brush kind of legislation. None of the prior efforts have gone anywhere. This one might not go anywhere either, unfortunately, because although there is a lot of support for it in principle, so far it's been difficult to attach it to any kind of legislation that's actually going to go forward for a vote in Congress. You all may have seen that ACOR released a news release yesterday saying that the House Ways and Means Committee just issued a mark of an extenders bill, which, you know, we're all familiar with extenders bills because that's what's authorized the ITC repeatedly over the last several years. While the extenders bill does not include ITC for storage. And that was one of the obvious vehicles to attach this to in order to get to a vote. We'll see where that goes. Obviously, it's just a mark of the bill. We don't know yet. Next slide, please. Depreciation, though, is a lot simpler to figure out. When you've got storage installed with other renewables, for example, solar, you can generally depreciate that battery or what have you over 5 years. Otherwise, it's a 7-year depreciation period. Longer if a tax-exempt person, quote unquote, leases the property. And the quotes are very intentional around that because I'm not even talking about just a normal lease. There's certain situations under the tax law that we treat as leases, strangely enough, even though they're not labeled leases. So that's always a good reason to have someone who knows what they're doing take a look at your contracts, particularly if, for example, your solar plus facility is installed on the roof of a school or a government facility or something along those lines. There is currently bonus depreciation, and what that means is currently, if you were to place in service a battery, even by itself, even standalone storage, you could depreciate the entire cost of that battery in the year in which it's placed in service. Bonus depreciation is a good thing and a bad thing. Obviously, it's great if the depreciation can be used by the owner of the battery this year. It does come with some cost, though. I mean, it can affect your financials if your investor can't use the depreciation right away. It doesn't pan out as well as just normal depreciation. By normal depreciation, what I mean is MAKERS, which is the modified accelerated kind of depreciation that we use. Double declining balance method allows you to basically front load your depreciation deductions over the first 3 years or so, and then it sort of tapers off the last 3 years. The other cost, of course, of bonus depreciation is depreciation recapture. And I'll wait to talk about that in just a second. Go ahead, Tracy, to the next slide, please. The good news right now for standalone storage, particularly, as well as behind the meter with separate ownership, when you're not sure if the storage will qualify for the ITC, because there are restrictions on when storage qualifies for the ITC, specifically how much power is fed from the renewable resource. One nice thing, though, is the Opportunity Zones incentive. I'm not going to go into this a whole lot because it's quite complex, but the Opportunity Zones incentive is essentially a capital gain deferral mechanism for investors. It works for standalone storage. It works for behind the meter storage. It works for storage installed with wind. It works for in front of the meter storage. It works for all sorts of different things. The catch, of course, is that it only works if the storage is installed in specific geographic locations. There are 8,700 plus, but they are specific. Now, a lot of them are in cities where the batteries are needed the most. A lot of them are also in rural areas where the generation facilities are. One of the nice things about Opportunity Zones is that eventually the investor will not recognize any capital gain if they sell their investment after 10 years. We think that also applies to depreciation recapture, at least in some cases. Depreciation recapture is very important when you're talking about storage, and particularly bonus depreciation, because what that means is that the person who took the depreciation deductions over time, when they sell the asset, they can end up with some ordinary income, which of course, if you're an individual, that means 37% plus potentially. So it can be quite expensive. We think we can avoid that with Opportunity Zones also, in addition to avoiding capital gain, which is great. And really quickly, Tracy, will you flip to the last Opportunity Zone slide, please? It's the one with the graphics. So this is a basic Oz model. Obviously, it's very important for investors for reasons that we can talk about separately. It's also helpful if you're running a fund, if you're a fund manager or you know a fund manager. It's also helpful if you're one of these Oz businesses, a qualified Oz business. Who is that? Sponsors, developers, people like that, people who need to raise money. And it's also helpful if you've got, for example, a local government authority or someone like that, or a development authority in one of these OZs, one of these 8,700 geographic locations, because you want to incent investment into your location. So lots more details that we can go into separately, but at this point, I'll pass it over. So I think, Buck, you're up next.
Yep, got it. Thanks so much, Elizabeth. I'm Buck Endeman. I'm here in San Francisco. I'm going to give a quick overview of some of the federal regulatory movements that we've seen over the last year or two. No doubt will be familiar to a lot of people. Then we'll change gears a little bit, go into some of the more recent development hurdles that we've seen for behind the meter projects, and that should flow nicely into Jim, who's going to wrap us up with financing and monetizing the agreement. So, Tracy, if you want to go to the next slide, the point is here on the federal side that a couple of years ago, battery costs started to decline. There's a recognition that storage could really help with some of the integration problems associated with high renewables penetration and more intermittency on the grid. And people started thinking, well, how are these energy storage assets going to fit into some of the federal market structures that have existed for years and years and years? Are these assets generators? Are they transmission assets? Are they some hybrid of the two? And it became pretty clear that changes in the market rules, at least on the ISOs and RTOs side, would need to be made to integrate storage resources. Next slide, Tracy. And that is when we saw Order 841 that was issued in February of 2018. And really the notable things about Order 841 were that it set a minimum size requirement of 100 kilowatts, which is pretty small when we're talking about federal markets. It's technology neutral, so obviously batteries get a lot of attention, but flywheels and other sources of flow batteries and other things are also included in Order 841. And the big thing from FERC was telling the ISOs and RTOs, hey, you need to really account for storage's physical and operational characteristics when you're designing your market rules and how they're going to participate. You have to let storage set a market clearing price. Notably, if the charging power used to charge the storage asset, you got to charge that at a wholesale LMP. And really, in sum, don't discriminate against energy storage resources acting as generation on one hand or load on the other. If we go to the next slide, Tracy, we'll see that we had our compliance plans filed at FERC in December 2018. FERC took a couple of months to consider those. The various ISOs and RTOs who some had a lot of experience with storage, others not so much. Deficiency notices were issued back in April of 2019 with instructions to the ISOs and RTOs to say, fix these plans, fix these integration plans by the end of the year. I'm not going to go through all of these deficiency letters. You can look at them, but I'll highlight a couple of notable parts. And first is, CAISO has been operating its non-generator resource and proxy demand resource models for a while. It's allowed aggregations to bid into the wholesale markets. They have some experience, and because of that, FERC said, well, CAISO, you look pretty good. You don't have to do too much more. On the other hand, you have, PJM, which also has a fair bit of experience with storage, but they're pretty strongly criticized over their 10-hour capacity duration requirement for resources. It's very difficult, particularly for battery resources, to meet that 10-hour capacity requirement. So you're seeing a lot of pushback on that. The next slide, we'll talk a little bit about Order 841A, which is really just an order that, or rather a request for FERC to rehear Order 841 on a couple of different grounds. Back in about a month ago, May 16th, the FERC issued an order denying that rehearing request. And the issue here is that opponents of storage didn't like the federal requirement that would require states and local distribution utilities to accept storage resources on their distribution systems. They thought it was federal overreach, and they like a brighter line between FERC regulating the wholesale and transmission system and states and local utilities regulating the distribution systems. Bernard McNamee said pretty strongly in the dissent that states and retail utilities should really have the ability to opt out of this federal requirement. FERC was being too heavy-handed with the integration of storage resources further downstream. It's a little unclear who would have actually opted out. Yesterday, a group of Democratic senators issued a letter that stands solidly behind a Republican-led FERC on the majority opinion that says, no, this is something we agree in. We believe in the ability of distribution-connected storage to integrate renewables and lead to greater reliability. That letter issued yesterday highlights the success of ISO New England in implementing a distributed solar and storage asset into its forward capacity market auction. So even in very partisan times, in the broader sense of politics, this is a good sign for storage when you have a group of Democratic senators really going out of their way to highlighting the success and what they believe is a strong storage position from a Republican-led FERC. So that's Order 841 in terms of the latest and greatest. The next slide talks a little bit about Order number 845. So if Order 841 is all about adjusting the market to accommodate energy storage, Order number 845 is all about interconnection. And from a development perspective, we all felt this was a really sorely needed order. We were happy to see it come out. We had run up against a few projects that had wanted to integrate storage or use existing interconnects to facilitate a front-of-the-meter storage projects. And utilities and RTOs were always really unclear how to model storage, particularly in a time frame that didn't scuttle the whole project. There are some workarounds you could do. There are things like limiting schemes that no one was really comfortable with or satisfied with. Wasn't sure whether this would be a material modification under an interconnection agreement. So FERC Order 845 really made significant strides in providing parties with a little bit more certainty. And it's a pretty technical order, but the biggest takeaway, if we go to the next slide, is that it's a lot easier to pair storage with renewable assets. under Order 845. You don't have to model and pay for the network and reliability upgrades as if, say, you had a 50 megawatt solar facility and 25 megawatts of battery storage. You no longer have to model that as if it were the same thing as like a 75 megawatt peaker plant. You can interconnect at less than nameplate capacity, and you have a little bit more flexibility to integrate and use the storage asset both in conjunction with and independently from the renewable facility. And we've seen that pave the way for some projects going forward. And it really reflects the realities of smoothing renewable generation of batteries and a lot of the benefits, both the grid stability and market development that can be had with that. So that's it from the federal side. We'll slide into the development hurdles on the next slide. And what I've tried to think about with this audience is looking at some of the development hurdles from a behind the meter perspective. What are you trying to do with the battery? And how does that interact with a changing regulatory environment? Next slide. So if you are behind the meter, what are some of the things you're trying to do with the battery? If you're in an area with high demand charges, how is that impacted if a local utility changes to time of use rates and relies less on demand charges? Are there going to be greater opportunities to look to the wholesale markets at the end of the Order 841 process, where you might have new opportunities that focus less at the distribution or utility level and more at the ISO RTO level? If you have portfolio projects and you're developing a fleet of behind-the-meter assets, you strike deals with different site hosts. Are those deals consistent? Can you operate your assets with some consistency, recognizing that you may have a fleet of batteries placed at various places around town with site hosts with various energy needs and requests and demands of their energy management software and batteries? Do you have anyone in your fleet that has negotiated a special right to terminate an energy management services agreement if it's not working out for them? What happens if that you no longer have control over that asset, you're no longer able to use that asset to bid into, say, a demand response scheme or something else? Also, development hurdles for behind the meter are fire code and zoning. There's been some well-publicized fires lately associated with battery storage projects. Currently, there are some local laws that restrict the placement or the amount of batteries or chemicals that you can have on a property. Some of these are targeted specifically towards energy storage resources. Some are just general good housekeeping hazardous materials laws under RCRA. It's not a major issue that we've seen yet, but we do anticipate more questions as these batteries and behind the meter projects get rolled out in more urban areas. And as hopefully the technology remains safe and gets safer, but to the extent there's any more incidents or accidents, that can definitely move the needle from a public policy perspective. Finally, when you're talking about behind the meter projects, it's really important to line up your incentives. What's the capital stack look like, and when's that money coming in? With SGIP, of course, depending on the system size, sometimes you get the money up front, sometimes you have to earn it out and make additional filings. If you're getting money from grant funding, is it a cost share? When does that money come in? Is it really a reimbursement rather than an upfront grant? The bottom line here with behind the meter projects, when you're balancing a lot of different assets at a lot of different locations that may have several different funding sources, you really want to have a complete understanding of the money available to you and when you can access it. Next slide, Tracy. Another development hurdle or one issue you'll really have to keep top of mind when you're going out and developing these projects is EPC and supply agreements. Obviously, you want to match your battery with warranty with how a system is expected to be operated. If you're handing over dispatch control to a market operator or utility, are they going to operate that battery system within the warranty parameters in a way that makes sense? So who bears the risk if there's a change in law or regulation? Obviously, the most famous is the PJM Reg D example, where PJM changed the dispatch signal and the batteries were operated in a way that was not contemplated and resulted in the projects becoming less profitable because they had much higher O&M costs. These are things and issues you want to work through with your EPC and suppliers ahead of time, so everyone can bear the appropriate risk that they are comfortable with heading into a project. With your battery supply agreements, what we've seen here is really the point, it's a competitive market. Are you going to get your batteries when you actually need them? What's the credit support look like? Are you obligated to give your supplier purchase forecasts? What happens if there are delivery delays associated with the battery product? Do you have any other obligations to customers or site hosts where those batteries are going to be installed? And then the last slide on development work risks is counterparty risk. And obviously, I'm in California, so this is really near and dear to my heart. And you really have to look, if you have a utility off-taker or a utility partner, will they remain creditworthy? Obviously, PG&E is in bankruptcy. Edison and SDG&E have seen their credit ratings downgraded in the recent months, and there's just a bit of uncertainty in an industry which has traditionally viewed the utilities as the most stable and most creditworthy entities. Just back in March, we saw the PG&E bankruptcy court approve a stipulation between Enel and PG&E to cancel three energy storage projects worth 85 megawatts. So significant projects that are now coming offline because the counterparty utility was deemed a credit risk, and the parties decided, our efforts are best served developing projects elsewhere, or not really, getting into a swamp of utility bankruptcy. So that's it for me. We'll head over to Jim Rathall to talk about financing and monetizing these projects.
Thanks, Buck. Yeah, this is Jim Rathall. I'm in the Washington, D.C. office, and our practice here focuses largely on financing and M&A transactions in renewables and energy storage from the developer side and also to the financial side. So we can go to the next slide. I want to touch briefly on some of the hot issues in terms of financing. One of the things that's really interesting, that the way the energy storage industry is growing, doubling year over year with the projections for, 1.2 billion by 2022. That's going to require a lot of capital, obviously. And what's interesting is that over on the financial side, there's equal interest and demand. ACOR did a survey of institutional investors earlier this year that ranked utility scale solar and energy storage as their top priorities for energy investment in the next few years. There's a lot of sort of demand and money on the sideline that's looking to get deployed. But there isn't as much activity as you would think, given the fact that there's sort of high levels of demand on all sides of this. And a lot of that has to do with the complexities, the transaction structures, and the risks, some of the things that Buck addressed, and some of the things we'll talk about in these slides. And so a large part of the challenge that we see for our clients and as a firm is helping to really bridge that divide and get to a place where we can be delivering a lot more capital into these projects and businesses. Here on this slide, you see, the key and sort of obvious points of what was sort of challenging to energy storage. The fact that these models are relatively new in many cases. They're the things that Buck talked about in terms of regulation and also market dynamics and changing markets. And then finally, the fact that with energy storage, the value creation is substantial, but not always direct, and perhaps not always resulting in certain revenue streams. Why don't we go to the next slide, please? So the comparison is that institutional investors are now quite familiar and comfortable with solar and wind. They understand those and are quite willing to invest, and that those are delivering large scale volume of capital. But the comparison with energy storage shows in detail some of the challenges. You don't often have a PPA structure that's delivering a contracted stream of revenues. You don't have sort of straightforward projects that where you install them and then sort of maintain them at a relatively simple level over time. Instead, you have quite complex operations with active management supported by sophisticated software that sort of introduces a level of technology risk and assessment that needs to be brought to bear by the investor. And you also have the fact that you have multiple use cases, we're all familiar with this, that are going to change over time. And so the question of what are going to be the financial outcomes for energy storage becomes a much more complicated modeling exercise that needs to be done as part of the diligence in order to really understand, hedge, and warrant against the risks and understand the revenue projections. I think the metaphor, if you will, solar and wind, you might think of as a checkers game. You go straight down the line. If you hit the boxes, you get to the end, you win. Storage is more three-dimensional chess, where you've got a lot of things that are affecting one another and changing over time. A lot more complex analyses that need to be done to make sure you're getting the investment right. Next slide, please. For behind the meter, we're really seeing some very interesting and successful development of new business models, particularly out in California, where you've got contract frameworks that are being put in place to deliver fleets and aggregated portfolios of assets that are both successful for the customer and are able to be implemented, in significant numbers and generate the right kind of revenues to warrant investment, both equity investment in the companies that are building them out, as well as project finance investment to make sure that the additional capital is there as needed. This slide shows a number of different kinds of agreements and structures that are being brought to bear. There's more detail on each of these in our handbook, and happy to go over them. The common themes here is the ability to provide storage as essentially a simple standalone proposition to a customer with little or no upfront payment, with a guaranteed savings against their energy bills over time, and with no or very little risk or management responsibility on the part of the host customer. And then at the same time, the developer implementer of the model is retaining ownership of the assets that are being installed and is able to turn back on the financial side and provide those as collateral and show steady revenue streams that are going to be generated over the course of 5, 10 or more years that are going to warrant the financial investment that's being made to build those businesses up. And we'll talk in a couple minutes about some of the examples of the companies that are being successful. The key here is simplicity. It's kind of like you're downloading your app onto your iPhone. These customers can simply sign up to what hopefully is a very simple contract and framework, one that's standardized and replicable across a portfolio, and that'll generate the volume and keep transaction costs down and allow for rapid growth. Next slide. Looking at sort of from the industry perspective, what are the major revenue opportunities? Well, we just talked about examples of behind the meter aggregation. There are a number of other areas that are particularly hot that people are looking at as being able to justify the kind of investments and returns to support growth. Substitution for natural gas peaker plants. There's a view that the costs coming down are going to create situations in many parts of the country, in the next 5 to 10 years where energy storage is going to enable complete replacement for peaker installations. Solar plus storage PPAs is another area that is very hot. We've been involved in a couple of those. There was recently a sizable solar storage announcement in the Northwest that we worked on that combined wind, solar, and a major storage unit. And that's seen as providing the benefits of a PPA. You have the contracted revenue stream and the creditworthy counterparty, but also building in the upside benefits of storage. It can be done at scale. We also have worked with clients on distributed solar storage PPA templates that are providing for smaller scale C&I implementations. That definitely is going to be a major part of the roadmap going forward. There are some definite complexities, though, when you get into solar storage PPAs, particularly around operational control of the storage unit, integration of the software systems across storage and generation, financial issues and efficiency about what happens when you had power generated but then goes into the battery and maybe not as much comes out, and how do you account for the compensation for that? So there are complexities and risks, but it is looking like a very successful model, one that we've seen work well in a couple of high-profile instances. And then the things that Buck touched on, well, yeah, just to go back quite quickly, in terms of specific state programs and wholesale markets, California obviously leading, but we're seeing a number of states out here in the East that are coming on, New York, Massachusetts, Maryland, New Jersey, where we're expecting to see some very substantial growth, and then the wholesale markets that Buck touched on. Next slide. So for energy storage, with the complexities that it brings in, to succeed in financing, you kind of have to get to another level of making sure that you've checked off diligence items and addressed the additional risks associated with system performance and software, and as Buck said, aligning the warranties with the use cases and the term, supplier risks. One of the things we're seeing a lot of is large corporate participation in acquisitions that is giving sort of a bigger balance sheet to these kind of projects and providing for more support for performance guarantees. We also see, in terms of financial models, that contract standardization and efficiency and bringing portfolio approaches where transaction costs are controlled is critical. I mean, when you get institutions that haven't been very involved with energy storage coming in, and with professionals that might not have been involved, then the level of diligence can quickly sort of, take off to a point that it creates, material economic challenges to these deals. And so achieving those efficiencies is while still making sure to cover off all of what needs to be done is critical to success in this area. Next slide. So in terms of the different types of financing, we're seeing, as the industry is maturing, moving up the curve from startup type companies that are funded solely with equity, VC, seed capital, innovative technologies and business models. You're starting to see more strategic investment and M&A from larger corporates that are enabling balance sheet financing. And we're also seeing examples of large-scale project finance with substantial amounts being put in by financial players supporting portfolios. And in addition, some standalone significant project finance examples that we've seen in certain jurisdictions where the markets are supporting them. Next. And so some of the challenges are sort of matching up the need for finance with the business model, the risks, and the demands of the financial participants. Obviously, when you get to debt and tax equity, you're getting into much more certainty required, much higher levels of documentation and greater transaction costs. But we're starting to get there, and we're seeing examples, and the financial sector is becoming, especially with certain firms that I'll talk about, much more familiar with the models and the technologies and willing to get out there. To mention a few companies, and I mean, I think it's critical to hear that when you're looking at financial partners, that these are entities that have put in the investment in time and effort. You've got firms like Generate Capital and CIT and Starwood and Macquarie, and recently Susi Partners, a firm out of Switzerland, that have dedicated funds and operations that are looking to invest in energy storage. They understand it, and that's vital to make sure that you can sort of get through to the investment. Indeed, it's a value add. We see a lot of these transactions where the expertise and experience of the institutional lender or financier, is adding to what's being the overall proposition and contributing to success. So getting the right player and participants is critical. Finally, I think the last slide. So key takeaways, planning early and extensively about how the corporate growth is going to proceed and what's the business model and what are the stages and what financing is going to be required. is even more important in an industry like storage, and so well worthwhile. As I just mentioned, working with investors and lenders very knowledgeable and comfortable in the space. And here's an area where getting the right technical consultant and feasibility analysis and financial modeling, this is critical. The level of analysis that goes into these transactions is far exceeds what you see with solar and wind, and rightfully so, because of all of the variables that we talked about that have to get sort of put through the analysis. And then finally, to talk about the legal side, and this is where we've been very involved, making sure that you structure the contract frameworks and the transactions optimally and efficiently to support the capital raise, avoid pitfalls, and keep the transaction costs in line is vital. We definitely have seen things bogged down where that hasn't occurred, and that's not what you want. So finally, the last slide, I believe. Just to point out that there's a lot of additional resources. We've been able to touch on some pretty high-level themes in this discussion. The Energy Storage Handbook we talked about. Beyond that, we participate actively with the Energy Storage Association at their annual meeting, and we at K&L Gates host our own event annually here in Washington, D.C., where we address all these issues for a full day with a lot of participation. And we're very happy to consult and confer, one-off questions that come up or things that we've talked about today. Please feel free to contact us. So that's all on the financing topic.
Awesome. I think I am going to pick up the ball next. Hi, everyone. This is Adam Gurza with Energy Toolbase. And let me show my screen. Tracy, maybe give me a confirmation. Yeah, looks like I'm good to go. So awesome. Well, thanks again, Jim, and thanks to the whole K&L Gates team, Elizabeth and Buck. I want to do one more last quick plug for this really fantastic guide. I just think it's a great resource. I've officially got this bookmarked on my computer here, and I encourage you to do the same. Okay, so boy, I was taking a lot of notes, and there is certainly a lot of stuff to wrap our heads around in the last 45 minutes here. Obviously, lots of development issues and hurdles that folks are facing. In my portion of the webinar today, I'm really going to kind of focus on two things, and that is incentives and financing transactions. And what I'd like to do, or I'm going to attempt to do, is to take a lot of the key material that the K&L Gates folks just, presented on, and demonstrate how we handle this in Energy Toolbase and model this into the economics of a behind-the-meter storage project. So starting with incentives, I got a slide up here on SGIP. This is always the first behind-the-meter storage program that gets talked about. We've already hosted webinars on SGIP and published blogs on how we really dynamically and precisely calculate SGIP incentives in Energy Toolbase today. Just as a really kind of quick primer, I think a lot of folks are already aware of this, but the SGIP methodology is quite dynamic. It's probably the most dynamic incentive program I've seen in my almost decade in this industry. 5-step program, projects over 10 kW, depending on if you're coupling an investment tax credit with the SGIP, you're going to get a different incentive level. Projects over 30 kW, which probably captures most of the commercial projects out there, you're going to get half your incentive paid as a performance-based incentive over a 5-year period, and you got to hit that minimum cycle requirement. And then there's also kind of some sliding scales on both duration and capacity of the storage system. As this relates to how this applies inside Energy Toolbase, I'm going to be jumping around our application a little bit, so I'll just go right into step 3. We've really attempted to streamline these SGIP incentives and make it really simple and intuitive for the user here in step 3 of the workflow. And obviously, this is just going to get displayed on a California project. You're simply selecting the SGIP incentive level that you're coming in at, and you're probably referencing like the SGIP trigger tracker page to kind of find out which level you're qualifying for based on where those incentives are at now. And then again, really, we do all of the legwork behind the scenes to really precisely calculate that SGIP incentive. based on all the different parameters of the project: capacity, duration. This is a PBI-based project where half is getting paid out, and we're also looking at kind of the cycling threshold. I'll make really quick mention here in the other tab. Some folks may or may not be aware of this, but inside Energy Toolbase, in addition to exposing, and you can really go in and view any one of our 50,000 plus global utility rate schedules. We actually do the exact same thing on the incentive side. So I've kind of gone here and I filtered some of the SGIP incentives. And I just want to point this out because if you were to kind of go in and look under the hood at how these incentives get created in our back end, I'm just going to kind of jump right into a reference value. This, again, is an example of probably the most complicated incentive in our entire database. But here's all the logic and kind of condition statements that we loop through when we're, again, calculating that incentive. And you can kind of just see some of the different categories like the duration decline and if it qualifies for PBI. So that's the back end. You really don't need to be concerned about that from your perspective as a user. We just want to give you the confidence and just a really great user experience to come here and select the incentive, and you'll know that we're going to calculate that really precisely into the model. Okay, I have one other quick slide on SGIP. I can't talk SGIP without kind of hitting on this really quickly. There are some really significant happenings right now with regards to the SGIP program redesign. Just a couple of weeks ago, on May 31st, the Public Utilities Commission released a proposed decision, and this was for the greenhouse gas emissions reduction requirements for the new SGIP budget. And for anybody that's kind of in the policy circles, this has been getting talked about for a year, so this is not new, but it is now very close to getting finalized now that the proposed decision's out. And you can kind of just see a couple of the bullet points here. What all is included in that PD, notably the penalties for projects that are not reducing emissions by the 5 kilogram by kilowatt hour threshold. All commercial projects will now move on to performance-based incentives. So we kind of do away with the old 30 kW requirement. The cycling requirement actually goes down. It was at 130, it goes down to 104. And then the fleet level reporting, both on the commercial and the residential side, this is new and this is significant, and just something to be kind of have on your radar now. And then when this stuff gets implemented, which I believe the target date right now is April of 2020 is the date that I think Brad Hevner at CALSA has given me. When these are really live and in effect, you'll have to get really familiar with these rules. It's nice if you're modeling your projects on Energy Toolbase. Again, we're fully intending to rebuild the 2020 program SGIP incentives into our database and have those again really calculate dynamically and precisely based off that new set of rules that are coming down the pike here. So I guess that's just kind of my big high level thought on incentives. I actually had some notes. I wanted to talk briefly on the SMART program in Massachusetts that a lot of folks are eyeing. I think if you know SMART and you know SGIP, you know that they're very, very different in the methodology, that dictates what the incentive level will be. The SMART program, it is a performance-based incentive also, but it is simply a kilowatt hour adder when you're coupling your storage system with a solar system. So it's actually, in a lot of ways, a much simpler program. We also have those incentives listed in our database, and we think we can calculate those really, really precisely as well. I'll probably not go into kind of demoing that just because I want to talk briefly on transactions before we go to Q&A. So again, the big picture thought is that incentives are clearly changing. Even existing programs like SGIP, the rules are going to be changing, and we fully expect to see more behind the meter storage programs, incentive programs rolled out in different states, which is why we're kind of really keying in on some of the those sections in the K&L Gates handbook. And we would fully expect that some of the methodologies And the way those programs get designed are going to be unique. And again, we're fully intending to kind of have all of those listed in our incentive database. Okay, let me pivot now and talk very quickly on transactions, and this kind of follows up on some of Jim's material. I was listening very closely on some of those new financing transaction types or structures that are popular in the market today. Step 6, for those of you that are not really familiar with Energy Toolbase, but step 6 of our workflow is, financing transactions. And we take a really similar approach here that we do on the incentive side, which is we can create any sort of financing transaction template in Energy Toolbase. And by the way, you can always ask your account manager to kind of work with you on this. We've got a lot of templates that we can just kind of copy, drop into your account. And I just took a quick pass at trying to create a couple of these shared savings templates. So for this particular deal, I just kind of threw in 3 separate transactions. And I just want to show you very quickly how this models into a cash flow. And for this particular shared savings model, obviously these get structured all sorts of different ways. This one here had a minimum payment, which I understand to be a pretty common structure where, if you're the host customer, you do have some guarantee of payment to the financier who owns the system. And then maybe separately, in addition to that, you're going to agree upon the revenue split. So let's just kind of take a look at a couple of these and how they kind of modeled based on those sample, terms that I put in here. So this is just one summary output page where I'm kind of comparing a couple of different shared savings transactions where, I think oftentimes you're trading off risk where you're either agreeing to a higher minimum payment to the financier in exchange for keeping more of the savings, and there may even be some kind of levers that you can work with your financer on. And again, from Energy Toolbase's perspective, we just want to give the flexibility to you folks as developers to really model those, however those terms get structured, and then present those into a cash flow table to your potential host customer. So this was a shared savings model where we just kind of had like an $8,000 minimum payment over a 15-year term, and then showing the entirety of the electric bill savings, which is the number that Energy Toolbase is really good at calculating. And this one here had kind of 80% going back to the financier. And oftentimes, I think when folks are structuring these, they're doing it similar to how they're doing PPAs, which is they're coming over to this far right column and they're making sure, any deal that they're presenting to their customer is in the black year one and hopefully throughout the whole duration. And again, we just kind of threw together a couple of different structures. And then here's also a PPA. I know Jim mentioned this one, and I've definitely heard this quite a bit over the last year or two in the market. When you're adding storage to the solar PPA, this is a very simplistic structure here. Again, I think a lot of times people are looking at what that total savings value is, and that's kind of the hurdle to figure out where they need that PPA starting payment to get to. And again, at the end of the day, if you're the developer and you're presenting this to a customer, I think you really are targeting to make sure the deal is in the black early on and for the duration. But this is just a specific case study. My summary thoughts here before we go back to Tracy for Q&A is that I think clearly we just heard that incentives are changing and they're going to continue to, and we fully expect to see new programs getting launched. Transaction structures are changing. I'd imagine a year from now when the K&L Gates folks are putting out their next edition handbook, there'll be some new dynamics in the market, and we're set up really well at Energy Toolbase to kind of model those changing structures. And ultimately, I think a lot of times people are trying to solve for a net present value or a total project return. So with that, Tracy, why don't I give it back to you? I'll just throw up the Q&A slide and you can kind of divvy up some Q&A.
All right, sounds good. I'm going to show my screen actually. Okay, We do have, I know we're kind of getting close to the top of the hour, but we have had some questions come in. So I am going to just, Adam, I'm going to send the first one to you. What will the incentive levels of the new SGIP program be like, and how will budget be allocated between commercial and residential?
Great question, hot question that a lot of folks are asking. I think it's very much to be determined right now. Energy Toolbase is a member of CALSA, and we sit in on a lot of weekly policy calls where these sorts of issues are getting fleshed out. And I think just recently also, separate from that proposed decision, a lot of the program administrators, which are obviously the utilities of the SGIP program, are putting forward their first proposals for what both the divvy up of the budget, that new SGIP money is going to look like. The divvy up between residential and commercial, and then the equity budget is for the low income folks. And then also what the actual incentive levels will be and kind of how they will progressively step down lower. So good question. I think that is like starting to get thought about right now, and there's no hard answers on that yet.
Okay. Next one, Jim, I'm going to give this one to you. Can you give more detail on how you're seeing shared savings agreements structured in the market today, and what is the common percentage split of the savings between financier and host customer?
Yeah, no, that's a great question. I think it's fair to say there's a wide range. There's a lot of different ways people are going at this, and market to market and business to business. But a standard is that sort of 70-30, 2/3, 1/3, with the customer on the 2/3 or the 70% range of the savings. If in terms of it being split straight up. Another model that we've seen is where there is a calculation of an expected annual savings that is essentially guaranteed to the customer, and then there's an incremental additional savings, which may be divided 50-50 between the customer and the provider. So, and I think that there's I believe there's a lot of variability on that. So does that cover it?
Yeah, that's good. I'm going to do just a couple more. I know we're coming to the end of the hour, but Elizabeth, I'm going to give this one to you. While we wait for more certainty from the IRS on federal tax credit eligibility for storage projects, for a commercial solar plus storage project today, am I safe to assume that the storage qualifies for ITC?
Yeah, absolutely. I mean, with the caveat that, of course, we have to worry about some limitations and some requirements, right? A certain amount of the power going into the battery or other storage facility has to be fed by the renewable asset. That can create some practical difficulties, as you can imagine, with monitoring and so forth. In particular, when you've got an off-taker agreement with the utility, and sometimes the utility wants to be able to put power from the grid onto that battery, sort of at their discretion. So there can be some practical things that we have to work through as the legal team, but it's absolutely possible. And done all the time, by the way. So.
Great, thank you. And I'm going to throw one to Buck as well. With FERC 841, do you think there will be opportunities for behind the meter storage projects to participate in wholesale market programs and get value streams from that in addition to utility bill savings?
Yeah, I think so. I mean, first off, Order 841 includes distribution-connected storage assets in its definition of energy storage. It was introduced with a separate DER aggregation rule that underwent some technical analysis and some workshopping. But the recent FERC rehearing order and the Senate letter in support of enabling distribution-connected storage resources is a good clue that market will probably be open. We can always fall back on our policy statement from January 2017, where FERC basically said it would be FERC policy to allow storage to get both cost-based and market-based revenues. And while that necessarily isn't a a firm commitment to bridge that front of the meter and behind the meter barrier. It does show some willingness and some flexibility to let storage resources perform to their greatest potential.
Okay, thank you. And let's see. People are asking about a free trial for Energy Toolbase to kind of do what Adam did in the platform. So Adam, I will pass that one to you.
Thanks, Tracy. Duh, I forgot to mention that. That was, I'm always supposed to close on that. Yes, we would love to set anyone up with a free trial, no cost, no obligation. You can test drive Energy Toolbase for yourself. And if you mention that you heard about us on this K&L Gates webinar today, we will give you an extended 30-day free trial. And that also includes, direct access to a account manager. We'll set up a lot of templates and really hold your hand to kind of let you really fully test drive our tool. So glad you asked, Tracy. Thanks.
Great. I know we're over, so I'm going to end it here. I do want to thank you all for joining us, and to the K&L Gates team, Elizabeth, Buck, and Jim, thanks again for jumping on with us and helping us co-host and bringing your expertise to the table. And if any of you have any questions, please reach out to any one of us. And again, we appreciate you all for joining us. Have a great day.